Welcome to Odds and Ends. I'm Dave Singh here with Rob Friesen, and we're trying to get our bearings on the week ahead and see how we can use statistics and the macro to get more out of StockOdds. How are you doing today, Rob?
Not too bad. I'm really happy to hear your voice is continuously improving.
It is.
So all that's behind you now. Good to hear. World is in quite a tizzy, eh?
Another big week. It's like every weekend we come in and oil's up 10%, 10%, 10%. So there's such big macro themes going on right now. How can traders still use statistics and odds in this kind of condition? I mean, can they?
Well, it's similar to last year. Like I even wrote an article about in the Stocks and Commodities magazine about the prospects for oil from really from August until November, till the end of November. And the prospects were, softness. So I would have been looking for, good oil stocks to short, kind of play the, the seasonal trend for a number of months, really. And, focused on the stocks that would have had the worst odds or the best odds of going down. So the worst odds of going up. But already in September, things began to change. And so I think you recall me saying a few times, very, very cautious on shorting oil stocks in the fall, which normally wouldn't be a problem.
Yeah.
So there was this supply chain thing and, just various factors already that when the reopening trade and just not enough supply. And so that was even before this war. And so we've already been climbing, from in the say 40s, 50s, all the way to, to the 80s, right? Mm-hmm. And then the war comes along, so that further enhances things. So again, I've been saying for a few shows now, going back quite a few weeks, that oil was, likely going higher, and my target was 147.27, and I just get that from like the all-time high.
Mm-hmm.
So that happened in 2008, right?
Yeah.
So let's talk about some other things, and then we'll circle back to oil. So gold is now at 1,994.70, and its all-time high was in 2020 at 2,089.20.
Mm-hmm.
But we haven't made a new high relative to that, but we're tracking up there steadily. So I imagine that's a good test number as well. When we look at copper and its role in so much manufacturing, electronics, there's lots of use cases for copper, and that's actually at a new high, $4.99. That's a new high for that. Palladium, which is, Russia exports a ton of palladium, 3,120. That's a new high as well.
Mm-hmm.
And palladium is actually used also in a lot of electronics, like catalytic converters, things like that too. So industrial and electronics. So there could be, some problem that way. We get into just the impact of all this on the food. We already had a problem just with the global lockdown in terms of food distribution and supplies worldwide, right? And then we added the inflation trade to that.
Uh-huh.
And, if you feel that the U.S. is experiencing inflation, that's nothing like some of these, emerging markets and developing countries. They're much more impacted, especially with food, which is a big deal, right?
Yeah.
So, wheat's high in 2008, which is incidentally the same as oil's high, was 1,349.50, and it's currently at 1,294. So it's not that far away from its all-time high.
Mm-hmm.
And then canola, which is used a lot food-wise worldwide, is a new high, a 1,109. So that's a brand new high. So we got copper, palladium, canola, all making brand new highs. So yeah, you've got a war that's only increasing the disruption and increasing inflation.
Mm-hmm.
Right. So let's circle back over to you to go through some of the seasonality that would normally be there, and then we can discuss how to view that. Okay. So why don't you go through that?
Well, we're not in the beginning of the month anymore, and we're a little bit too early for mid-month. We just had our first Friday seasonality, but I thought this time I'd take a step back and look on a monthly basis.
Right.
So for the month, what might we be doing? And it just seems like there are certain sectors that might slightly outperform or underperform. Like energy is expected to underperform the spider, but we have such a giant macro theme, we can't rely on that. And something like financials would underperform the spider.
No, but this is an important thing. So we just need to run through what would be normal seasonality, and then say, okay, if oil for the month of March is normally weaker, which is to be expected to some degree, because you kind of get the December, January, with winter season and things like that, where consumption can rise. And then you get this break before the summer, because we can often have higher prices in the summer, which culminate about Labor Day too. So March and April can be those retracement months for it. So normally oil would be softer for March.
Yeah, like XLE is down 3.2 versus minus 0.5 on the spider. So it's quite significantly down.
But so that would be the normal. But because we have a macro that is completely overriding that makes the current macro even that much stronger, that much more important, right? Because normally it would be a softer period of time for oil, right?
And same story for basic materials. XLB is significantly, it's down 1.53% for the month relative to down 0.5% for the spider. So that's very similar too, but we're seeing the opposite.
Yeah. So that doesn't, I don't have a problem with what's normally expected with seasonalities and then having a macro come and punch it and, boot it out of the way. I don't have a problem with that, because I like to know what is normal so that I can gauge the seriousness and the impact of something that's encroaching on the normal. Does that make sense?
Yeah.
Okay. So it's not like, oh, it's not valid. It is absolutely valid. It's just that, I'll give you an example of this. You have a plane and it's taxiing down and, getting ready to take off on the runway. Okay. Now, as it didn't lift up into the air until it got enough speed, right? So gravity was holding it down onto the runway. But at some point when there was enough speed, it created lift, and that lift overcame gravity. So lift is like a macro, where gravity would be like the seasonality. It's still there, it's still real, it's still going to be important, but something came and interfered with it, right? So another law, another force. So the law of lift overcame the law of gravity, but gravity's still there. Right? And so here's the thing, if there was a resolve, if we had peace, if this thing was resolved, then, you'd probably pull back harshly and, you'd be going the way of seasonality from where we are now. So keep it in mind, keep it in perspective, and allow macro things to be considered. This is the part of the vetting process. I can go and curate a whole bunch of symbols, and some of those symbols might have the odds of going down, normally. But if they were oil stocks or they were gold stocks or whatever, I would say, no, I'm going to vet that. I don't need to be involved. I don't need to get into that fight. I don't need to tangle with that. Just remove it. Or, be long. And the thing is, I am long a bunch of oil stocks over the weekend. I've done this a number of times in the last couple of weeks in terms of even preparing for what I thought would happen with the invasion, and then continuing on as the invasion was going on. And that is gold and oil certainly has much more room to move higher. So, not that risky to be in those type of things overnight. That is sort of, you can kind of lift that out. Like to take a stock like Snowflake or something overnight, can have a significant element of risk, right? But like when you're in a macro and you want to take an oil stock overnight when when all the signs are flashing. So I had thought that we might have some meetings this weekend and already an embargo would be announced. But it's been chatted about, but it doesn't look like it's happening. But still, oil's rising, and that's just because the intensity of things, with cruise missiles hitting the airport, and I mean, this thing is just getting uglier and uglier all the time. So, I don't think it's. I think Putin's going to double down rather than back away, right?
I mean, he can't back away. If he backs away, he has loss of life, all this expenditure, loss of face, right? And he won't. He'd rather just plow forward, or like you're saying, double down.
Yeah, because now it's, there's elements of pride, and it's kind of like when you're already invested, right?
He's all in.
You're pot committed. What do you do, right?
Yeah.
So it's really sad. I mean, this is just, it just moves you to tears just even seeing things that are going on. It's just insanity. But we're traders, and we have to, take the information and act on it. So the trade for me is still long basic materials and long oil. Financials could be, considered to be a short. Again, it depends a little bit on what the bonds are doing before you get too committed on that one. Industrials, there's plenty of legs in industrials just because of, some of the defense contractors are there. But industrials also have airlines in them, right? So even though we consider airlines discretionary spending too, they are in the industrials, so they can interfere a bit with that trade.
Utilities are interesting. I mean, on a monthly basis, they outperform the spider typically in March, and they've been very strong the last day, week, month. So, I mean, this is a case where the seasonality is along with what's happening recently.
Okay, so you've got, let's say on the monthly, on March monthly, on seasonality. So normally GDXJ, GDX, SLV, and XLE would all be shorts for this month. So let's take those and put them into the long camp, okay? So we're going to override seasonality. But what about KRE and KVE, which are the banks, regional banks? Do you want to leave them in the short category? Any reason to argue with that?
Well, like even tonight, the 10-year is pulling back a bit, right? So that's going to be a good shorts on financials for tomorrow if it stays the same. So in that case, it is. And we did kind of go towards that 2% on the 10-year. But then this whole risk-off mentality has been pulling the yield down as well. So I think it's okay to leave the banks in the short camp.
Okay. Well, we can leave them in the short camp, but we'll check them out tomorrow. We've got the Dow down 1.09% or 367 points at this moment. So that might impact all groups. It's not like, so when you look at the long side and you see that, XLU, semis, and XLP, consumer staples are longs, but all that can still be pulled down by the market, right? part of the problem. So what we want to do is we want to find some groups that we can be long and some groups that we want to be short, and we're going to make money on the relative performance between them, not the absolute change by direction, but the relative change, right? So anything more to run through on the seasonality there?
Not anything else on that.
Okay. So let's we got S&P's down 1.38%, a little bit more than the Dow. So that shows me that even though the Dow number sounds large, like down almost 400 points, it's a little bit stronger than the S&P, which has obviously some technology exposure and things. NASDAQ 100 is down 1.85% at down 255 points. None of them, they have not hit the low from February 25th. So all three of those markets are still above the low from February 25th. Russell 2000 is down 1.86%, so same as the NASDAQ 100 percentage-wise. And then we've got, interestingly, the Nikkei is just getting crushed here. It's almost back to a former resistance level, which I'm going to call out that number right now, to 23,216.90. So just below the, actually, sorry, wait a minute here. Hold on. No, I made a mistake. 24,500, let's call that roughly. So 24,500, and we're at 25,000. So not much further to go. It's already, well, it went down 670 points, minus 2.61%. So the Nikkei completely in an air pocket until it gets to that former resistance level. The DAX is, you know, almost looking like it did back in 2020. I mean, it's still quite off that low, but the way it's falling is like what we saw in the March of 2020. And the VIX, mentioned on a show last week that the VIX was scheduled to continue to rise, and it's up 6.57%. We're at 3360. Right now. We've pulled back a little bit from a bit earlier. It was up over 34. So again, when you get like the VIX heading towards 35, this means that things are going to move around a lot. Like we could open down tomorrow, and we could actually pop up for a bit and then turn over and go back down further, and then, you know, we could be way down and have a late day rally. I mean, this is what volatility does. You know, it's not a slow climb all day with good breadth of a market, or even an orderly sell-off all day. No, when you get a high VIX, it's going to move both ways. It's a trader's market. And so yeah, so if you put a long and short basket on, and you know, you find that your performance is quite excessive early in the day, because volatility is so high, I wouldn't have a problem taking that, because you could be, you know, you can be up a lot and then it can reverse on you too. So being more of a trader's market, focus on capturing profits, locking them when you can. Keep an eye on the VIX. Okay, so I don't know what developments are going to improve the situation. I just see things kind of getting worse. But, you know, it's a fluid story, so you don't know, right?
And this is going longer than people. They said, oh, this will be done in two days, 3 days tops. This whole thing will be over if they invade. Now it's dragging on. It's looking like it's going to be a slow grind, just continuous. So the market's just slowly digesting that. But it's also reacting less and less each time bad news comes in. So at some point, it becomes numb to new news, and then we'll see. Yeah.
So let's talk about the oil complex here again. So it's at crude oil is at or West Texas is at 124.08, up 7.26%. I think it did pop up a bit higher, just over 130 when it opened today, and it pulled back from that spike. So it had a super spike up over $130 a barrel and pulled back, and now it's at 124.08. Okay. Brent crude also almost spiked to 140, and then it pulled back to 128.11. So I mean, still a massive jump, but not as extreme as right when it opened. So there was a bit of a shock when things opened. Now gasoline is making a brand new all-time high. You've never had gasoline futures at 377.47 ever. You know, even in 2008 when oil made that high, the highest they got to is 363. So we're at 377, so higher than that. What is it at the pump when you got to fill your Jag up there? What is it?
We're close to $6 a gallon in Southern California. It's $5.90 something. So I saw one station with $6. So that's pretty pricey.
Yeah, we're over $2 a liter now here. So not quite 4 liters to a U.S. gallon, obviously.
That's close to $8.
Yeah, so we're still higher. We've always been higher anyway, but yeah, it's getting pricey. Heating oil is coming up to its all-time high, not quite there, just a sliver away. Natural gas, not, yeah, it's up, but it's still pretty much in the middle of its 10-year range, and ethanol also in the middle of its 10-year range. So the big one is the gasoline futures. They're going bananas here. So there you have it. So what is our focus tomorrow? I think you want to play kind of in the healthcare, some industrials, some utilities. So again, take some balanced longs and shorts from that. The ones that are more sensitive are going to be REITs and financials, just based on what the bonds are doing, and the dollar to some degree. We don't want to be shorting basic materials and oil if we don't have to. The tension is this: you could have something really move a lot on a close-to-close basis or gap up a lot at the open. It could actually be down from the open to the close. So, you know, that's possible for gold. It's possible for oil. We've seen that before. But the way things are escalating right now, I would just give it plenty of room. So what other groups are there? We've got
utilities have been so strong, though. I mean, I think I wouldn't want to short utilities. I mean,
utilities they're just going to pass on the inflation to the consumer anyway, and you know, they're sensitive to bonds too because of the bond component. So, but you know, consumer staples, you do have to watch out for some of the companies that can't pass on the inflation to the consumer, that are really impacted, or their margins are being squeezed. And this is happening, you know, company after company, where you know, they might have had lots of contracts in play. Like, I mean, imagine that you intended to build a house like this. Say you were going to build a house this March or this April, and you know, everything was prepared. You bought the land and you were going to build, and you hadn't ordered your lumber. Now you got to order it, right? You know, all of a sudden your budget's blown, right? You never planned on the increase in lumber, let's say. This is happening throughout the economy in so many different groups. Just margins squeezed everywhere, right? So it's a bit of a mess. Now you've got some other systemic things too. Companies that are interconnected, companies that have made investment into, even into Russia, investment into there prior to all this. I mean, ESG was having some issues with ESG companies and goals. We've had, look at what's happened with all the environmentally friendly stuff. Electric vehicles, we're seeing Tesla still holding up and performing okay in spite of the way the markets are, but not all EV companies are experiencing that type of support, right? Even though oil's going up, not all EV companies are going up, right?
Like solar, it's down like 30% in the last 3 months, and with oil going to
well, and really that's just because it's like, we thought we didn't need oil again. I guess we were wrong, and so many of these have such big capital investment still, and such a long runway for return, that it's the easier thing is just to get rid of all that stuff, anything speculative, anything that is not going to produce right away, and just go to cash or reallocate. And we've seen so much of that. Look at you got SPACs that even should hold up at $10, and they're way below it. Some SPACs are down in the twos, or under $2. I mean, there's a lot of de-risking going on everywhere. So
about Bitcoin, we didn't touch on that yet. I mean, that's a good.
Well, Bitcoin is an interesting one because it does have some use case for. It could be kind of like your rainy day fund, your slush fund. It could be even more imperative that I've got to move stuff to crypto, so because the ruble's falling, and while you can, other countries might fear the same thing, and so Bitcoin is a currency, but it's not necessarily an inflation hedge in general terms, but it could certainly be a hedge against a falling currency, right?
It's down 4% right now.
Yeah, it's suffering the same risk reduction, but it did have some rallies along the way. Even how many days ago was that? We had a pretty big rally on February 28th, right? And it's going to happen again. We're going to see other rallies, especially if we have more banking ripple effect. So I don't write off Bitcoin overall as a way to pay for things if you have a problem with banking and things like that, but some of the other currencies can't argue the same, like the other crypto stuff can't argue along the same lines as that. So Bitcoin will still be the granddaddy, and it's more similar to gold as a potential hedge, but gold is certainly doing a lot better than Bitcoin at present. Just like we saw, I heard so many people talk about fundamentals don't matter. Over the last number of years, right? Until recently, we started to see them matter in November and December, and they really mattered in January. And gold, same thing. Did you not hear gold is dead? And now look. And maybe in the U.S., gold isn't such a big deal, but many of these other countries, they still value gold, and they will purchase it. They will,
China, India,
foreign banks. They'll buy gold. So you can't write it off entirely. And now you're seeing, big move. We're not taking out all-time highs, but we're getting awfully close. So I don't know. I mean, we could banter on. It's like I said, it's very fluid. But you gotta put your trading hat on and you gotta trade. It's a trader's market, it really is. It's like 2008 all over again. And 2008 was macro driven, right? 2007, 2008, 2009 were macro driven. 2018 in December, we had a bit of a macro driven thing as well. Some of the summers, due to, politics, we've had a bit of macro. And then 2020, we had COVID, and look how far we fell and look how fast we rallied back, but all again macro driven. So statistics matter in the sense of here's what I would do. If you like the basic materials group for some long ideas, then you go in and you find the ones that are most statistically advantaged. Because how else do you decide from that list which ones you're going to pick? And if you were to just pick one out of the 50 stocks, you might not pick the right one. So it's better to pick 3 or 4 or 5 in the group that have the best odds of producing for the day. Do the same thing with some oil stocks if you want. Now, you might have a trouble buying them if they're already gapping up a lot. So you might say, well, okay, that train left the station, I won't get involved. But you can do it with some utilities. You could probably do it with some basic materials. There's probably some even in discretionary names that are worth looking at from the long side. There's going to be some technology names still worth looking at. Even in this environment, when everything's going down, some technology stocks will go down less, or they may not go down much at all. So go to StockOdds and grab some groups. But unless you have clear directives, be balanced. Get some longs and shorts within the group. Don't have outright exposure. Right? And as this oil trade gets longer and longer in the tooth, meaning that it just keeps rallying, at some point we're not going to want long exposure to that either, because those reversal days, when the profit taking days or some good piece of good news comes out, those stocks will be going down pretty hard. Always happens, right? Everything goes up until it doesn't.
Yep.
Right. So even back in 2020, when gold was rallying, when it turned, it pulled back hard, and oil hit brand new highs in 2008. And when it turned, it fell all the way down to $38 a barrel from 147.27. It fell to 38 in a matter of months. So when these things finally finish, they can reverse hard. So keep that in mind, okay?
Well, it'll be an interesting week.
All right. Well, you take care of yourself, and